Welcome to the deep dive. Today, we're tackling a really fascinating story playing out right now. It involves the billionaire investor, Bill Ackman, and his huge bet on Hertz, the car rental company.
Right. And what makes it so interesting, really, is that Ackman is super bullish, like really optimistic, but that flies completely in the face of what most Wall Street analysts are saying. They're, well, pretty negative, actually.
Exactly. Ackman's a big name, known for these high-conviction plays, both long and short. He's not shy about controversy either. Think back to that whole Herbalife battle with Carl Icahn.
Oh, yeah, definitely a history there. He stands his ground.
So his firm, Pershing Square, now holds almost 20%, 19.8% to be exact, of Hertz. And the market reacted instantly, didn't it? The stock more than doubled back in April, right after the news broke.
Yeah, a huge jump. So the big question is, what's Ackman seeing? What's his thesis?
Well, that's what we want to, dive into. What's driving his optimism? And on the flip side, what are the red flags the analysts are pointing to? We're using a recent Motley Fool article to help us sort of unpack these different takes.
Okay, sounds good. So nearly 20%. That's not pocket change. That signals serious belief.
What are the pillars of his argument, according to the article?
Okay, so first off, he expects more rational behavior from Hertz's competitors.
Rational behavior, meaning what exactly? Less cutthroat pricing, maybe?
Probably something like that, yeah. More discipline on pricing, managing their fleets better across the board. Second, he thinks Hertz is getting its own house in order, especially with its EVs.
Ah, the Tesla situation.
Yeah.
That's right. They bought that massive fleet, 100,000 cars back in 2021.
Yeah, huge announcement then. But it didn't quite pan out as planned. Renters had concerns, charging anxiety, things like that. Demand wasn't quite there.
And that led to the previous CEO stepping down.
Right.
Back in March. That's right. And Hertz ended up selling off about 30,000 of those Teslas. So Ackman sees this right-sizing as a positive step.
Makes sense. Adapting to the reality on the ground.
Yeah.
What else is fueling his bullish view?
He's also pointing to the new CEO, GilWest. He's got serious operational chops, former COO at Delta and GM. So the idea is, experienced leadership can steer the ship better.
Okay, leadership's key. Anything else?
And then there's Hertz's capital structure. It's leveraged, meaning it has significant debt. Ackman sees this as a potential plus in a turnaround scenario.
Leverage. That's always a double-edged sword, isn't it?
Yeah.
Magnifies gains, but also losses if things go wrong.
Exactly. It suggests Ackman feels the potential upside justifies that added risk.
So it's about internal improvements, leadership, any external factors or macro trends he thinks will help.
Ah, yes. This is where it gets really, really interesting. Tariffs.
Tariffs. How do they play into a car rental company?
Well, Ackman's theory is that trade tensions and tariffs are likely going to push up used car prices. Now, think about Hertz. They own 500,000 vehicles.
Wow, okay. A massive fleet. Worth what, roughly?
Estimate around $12 billion. So Ackman figures even a, say, 10% bump in used car values. That's a $1.2 billion gain on their assets.
$1.2 billion.
Yep.
Just from asset appreciation.
Yep. That's nearly half their market cap back in April. It would be a huge boost, kind of separate from their day-to-day rental business.
Okay, that is a compelling angle. Potential windfall from the macro environment. Any other potential catalysts on his radar?
He's also floated the idea, maybe speculated a bit, about a deeper partnership with Uber. Pershing holds a stake in Uber too, remember?
Ah, interesting. Synergy potential. What kind of collaboration?
He mentioned autonomous vehicles, maybe down the line. And it's not just him thinking out loud. Uber's CEO, Dara Khosrowshahi, actually responded positively on X, saying he was keen to brainstorm expanding their current relationship.
An Uber tie-up, especially around future tech like EVs. Yeah, that could definitely be a long-term game changer. Okay, so what about the numbers? Does Ackman have specific financial targets in mind for this turnaround?
He does seem aligned with management's targets. They want to get fleet depreciation, DPU, they call it, down to around $300 per unit per month. It was $422 in Q4 2024, so big drop.
Right, managing costs better. And on the revenue side?
They're aiming for revenue per unit, RPU, of about $1,500 a month per vehicle. It was $3,376 in Q4, so a decent increase there too.
Okay, lower costs, higher revenue per car. And if they hit those targets?
Ackman projects Hertz could reach $2 billion in adjusted EBITDA by 2029. And applying, a pretty standard 7.5 times multiple to that, he gets to a potential stock price of $30.
$30, wow. Compared to the, $7-ish it was trading at in late April, that's a more than 300% gain.
Exactly. A huge potential upside based on hitting those operational goals and maybe getting that tariff tailwind.
Okay, That's a very, very rosy picture painted by Ackman. Lots of things need to go right, but the potential payoff is clear. Now, let's switch gears. What about the Wall Street analysts? Why are they so cautious, even bearish?
Well, yeah, the contrast is stark. Looking at analysts covering Hertz over the last 3 months or so, the consensus is basically a sell.
A sell. How does that break down?
Out of 4 reports, it was 2 holds and 2 sells. So yeah, leaning negative overall. And their average price target, just $2.93.
It's $2.93.
Yeah.
Compared to Ackman's 30. That's a massive disagreement. What's driving that pessimism?
Well, take Bank of America's analyst John Babcock. He actually noted the higher share price post-Ackman could, help Hertz raise needed cash. He figures they need about $500 million this year and next based on cash flow.
So silver lining maybe, an opportunity created by the Ackman effect.
Perhaps. But Babcock still rates the stock underperform with an even lower target of $2.70. The main worry seems to be Hertz's actual operational performance lately.
Like what specifically?
Yeah, like the fact they lost nearly $2.9 billion in 2024. That's a big number. And they've been struggling with vehicle utilization, how often the cars are actually rented out. And that RPU figure we mentioned, revenue per unit, it was actually down slightly year over year in Q4.
Ah, okay. So analysts are looking at the recent track record, the actual reported numbers, and seeing struggles, not the turnaround Ackman envisions just yet.
Pretty much. They seem more focused on the what is rather than the what could be.
And what about the company's financial health overall, beyond the operating metrics?
That's another major concern for the analysts, the debt load. Hertz is carrying significant debt. And as the BOFI analyst suggested, if they do raise capital by issuing more stock...
That dilutes existing shareholders, right?
Yeah.
Each share becomes worth a smaller piece of the pie.
Exactly. So you've got operational concerns, debt concerns, and the risk of dilution. It paints a much riskier picture.
Definitely different narrative.
Yeah.
The article also mentioned some of Hertz's recent turbulent history, didn't it?
Yeah, it's worth remembering they filed for Chapter 11 bankruptcy back in May 2020. The pandemic just crushed their business.
Right, I remember that. They emerged in 2021, but...
The article notes they're apparently still dealing with some legal fights with creditors from that whole process. And then there's the meme stock angle.
There's stock. Hertz.
Apparently. The article suggests Hertz was kind of an original meme stock even before GameStop blew up. So there's this idea that its price might sometimes be driven more by, internet hype and speculation than just business fundamentals.
Huh. Bankruptcy, legal issues, and potentially meme stock volatility.
Yeah.
That just adds more layers of complexity and risk, doesn't it?
It really does. Makes it harder to predict based on traditional analysis alone.
So given all this, what was the final take from the Motley Fool article's author? Cautious, I assume.
Very cautious. The recommendation was basically, if you're tempted to invest, maybe consider just a small speculative position and keep a close eye out for either dips in the price to buy in lower or, more importantly, actual concrete signs that the operational improvements Ackman is banking on are starting to happen.
Right. Wait for evidence before going all in, given the high-risk, high-reward setup and unknowns, like a potential capital raise.
Precisely.
Okay, so summing it up, we have this classic battleground. Bill Ackman, the activist investor, sees a clear path to a major turnaround. Better operations, smarter strategy, help from used car prices, maybe even a boost from Uber. He's putting serious money behind that vision.
Right. And on the other side, you have Wall Street analysts looking at the recent losses, the operational challenges, the debt, the potential dilution, and saying, whoa, slow down. Their price targets suggest significant downside risk.
It really highlights the massive gap that can exist between different expert interpretations of the same company. The potential upside Ackman sees, that 300% plus gain, is huge, but the downside risk flagged by analysts is just as significant. So many things have to fall into place for either scenario to play out.
Absolutely. It's definitely not a straightforward situation.
So, for you listening, considering everything we've discussed, Ackman's thesis, the analyst's worries, the company's history, the potential market weirdness, what signs or signals would you watch most closely to figure out if this Hertz turnaround is actually happening or fizzling out? And maybe think about how this whole situation really illustrates the core challenges of investing, assessing risk and potential reward when the experts themselves just don't agree. Definitely something to chew on.